Hi, and welcome to the show. I have the pleasure to be joined today by Georg Hauer. Georg is a European fintech pioneer, an early fintech entrepreneur in the space of digital banking, where he led the development and growth of German digital bank N26, including as a general manager, followed on by roles in fintech and AI compliance startup Hawk AI. Georg is now an investor and advisor in the neobanking, banking infrastructure, and banking digitization area. Georg, great to have you.
Thanks a lot for having me, Ivo.
Great. Yeah, let's go right into it. Banking and neobanking. I want to talk to you about how is banking changing again? Like what is happening post the initial first waves of digitization?
Yeah. So generally speaking, innovation in banking has never stopped. But what we are seeing is that the innovation is changing. Whereas in the last 10 years, there was a lot of innovation happening in digital banking, especially on the front end. So when a lot of banks were speaking of digitizing their core business, their retail business, they were speaking of launching an app, creating a better user experience, potentially streamlining the customer-facing processes. What we're now seeing that a lot of banks have started to digitalize their back end. And there's a lot of innovation happening in the background right now. And as a matter of fact, this innovation right now might be actually more fundamental and more groundbreaking than what we've seen in the past 10 years.
Right, because now we're really talking about automation of process that they were just the first use cases were kind of like customer facing, convenience, user experience. But in the back, you had the old technology, the old processes, the old ways of working with the inefficiencies and costs, right, of the past.
Absolutely. And as a matter of fact, it was very challenging for a lot of traditional banks to build a very modern front end with an extremely old back end, because combining those two isn't as trivial as it seems. And sometimes even certain innovation were blocked in the front end because they just didn't fit with the back end. And one great example is real-time banking. That's a big challenge even nowadays for many European and, frankly speaking, global banks.
Global banks, right. An interesting thing there is that on the one hand, the legacy technology is stable, works great, but then you see this also, I think, in your travels. It'd be interesting to share your travels across the world, really, and looking at the banking space and how it's developing in, let's say, underdeveloped, developed, and developed economies in the West and in the East. Where do you see the differences? How is the approach different to solving this back-end digitization challenge?
Yeah. So I am in the lucky position that I get insights into many different markets, and I have the chance to work for banks and fintechs basically around the world. What's interesting is that the need for banking, technically speaking, is actually the same all around the world. People need to receive money, they want to spend money, they want to automate certain recurring payments and want to share money with friends and family. However, how banks have historically grown is very different. And what we're seeing right now is that Europe and the West in general, including the US, has already many very large established banks, meaning the SME management are much larger, but that also means that the entire technology foundation is a lot older. That is one of the reasons why Europe was actually, you could argue, I would say the nesting place where some of the first really large neobanks have been founded, such as N26 or Revolut, for example, and many others. However, what we're nowadays seeing is that many other markets are following, and especially in Asia, there is a massive revolution in banking. However, what many Europeans are failing to see is that revolution has actually started already quite a while ago, and it didn't start from banking. So it wasn't the banks that innovated, but it were other technology players that moved into banking that drove that kind of innovation. And that's why a lot of I would say, the tech stacks in Asia are a lot more modern than what we've seen with the traditional banks in Europe. Meanwhile, many other continents and regions are now fast followers and building very modern banks.
Very modern banks, meaning they really try to reimagine this from scratch and not trying to bolt on changes here and there. Do you think this is something that is the arena of fintechs, or do you think that actual legacy banks that realize that they have missed the first and the second car of the train, maybe they want to hop on the third, that they have a chance? How do you see that dynamic playing in these more dynamic markets?
Yeah. So first of all, many CEOs of established banks do not like the term fintech because their main argument is that banks have always invested more into technology than essentially any other established industry. And that's partially true. The only problem is that their massive investments went towards very old-fashioned technologies. And meanwhile, nowadays innovation cycles have accelerated so much that it isn't sufficient anymore to invest massively every 10 years or every 15 years, but rather you need to become more agile and build more modular infrastructure where you can expand and add new innovations, whereas many established banks struggle to do exactly that.
In investing in that technology, one of the issues that a lot of CEOs maybe didn't see or maybe underestimated was that, as you mentioned, investments went into something that's not really building for the future, but kind of fixing the past. The modular technology also means that when you build new stuff, you have to shut down old stuff, and that's really hard to let go because of processes reasons. Where do you think legacy banks got things right? Because some of the things they missed, but what did they get right, you think, in this first digitization wave?
Yeah.
In terms of agility?
Generally speaking, there's certain strengths that banks can build on. And one particularly important one is a very diversified business model. And digital neobanks, typically, they kickstarted in the past 10 years very much focused on the checking account and weren't particularly strong initially, at least, in lending, in trading, or even more extreme towards mortgages, for example. This is, however, what you would call the bread and butter business of many other retail banks across Europe. And I'm not even speaking of the classic corporate banking, which, frankly speaking, is the cash cow of many other established banks in Europe. So what are they getting right? So they're certainly getting right that they are not just digitalizing their retail business for end consumers, but rather they're trying to digitalize the entire business holistically. That is why, however, it takes about 10 times as long as it should take. And on the other side, they do fail occasionally to digitalize certain processes that are key. So often banks try to digitalize whatever is easiest first, which results often in a case that 80% of all processes are digitalized, but you didn't get to 100. And until you get to 100, only then that's when customers really see and benefit from full digitalization, because for the remaining processes, they still have to go to the branch.
That's actually a very interesting topic, full digitization, that it's basically non-linear, right? I mean, what we've seen is you look at the use cases. Listen, obviously, let's go for the for low hanging fruit. Let's do the things that make sense. But then you leave out and not digitize things that either the business case is not that great or the costs are so low where, like, why should I digitize this? It's already okay. But then you miss on having this completeness. And because you miss on this completeness, you lose the agility to kind of move forward with things so this non-obvious, non-linear way how digitization pays off is, I think, ties very well also with my observations of what's going on. What about neobanking? You mentioned the profitability is the main struggle, right? Checking accounts, you get a lot of customers, but are you really making money with these guys? I mean, they're scrolling the app and paying for stuff with lower fees, while the big banks are looking at this and saying, wow, are they doing this? Doesn't make sense. At the same time, is there something like too small to comply or too small to get some of that profitable corporate business that you mentioned? How do you think these new banks should approach the profitability challenge?
Yeah. So generally speaking, first of all, there are new banks out there that are profitable. And many of them, however, are not based in Europe. They are based, for example, I think a great example is Nubank, which is nowadays, you could argue, the largest digital bank outside of China, with more than 80 million customers. And they are profitable and they're listed. And there are quite a few other examples as well. What I would argue is, in order to become profitable as a new bank, you have to master 1 out of 3 business models. One is lending, one is corporate banking or SME banking, and one is investment and trading. So far, many of the European neobanking giants have focused on checking accounts and premium accounts. And to be very clear, they have been doing very well with that. And it does make sense to focus first on one dimension, make it really, really well and scale that, and then expand to other dimensions. So as a matter of fact, two thoughts here. So first of all, we're way past already the situation where neobanking customers are only using the neobank because it's for free. Nowadays, a lot of customers are willing to pay and stay with a neobank, not despite the fact that they don't have branches, but because of it, because they just have overall a better user experience. And that's what they're actually looking for. And the second aspect is many neobanks have built a very strong and sustainable and sticky customer base. And now they're slowly moving into these other pillars, which I mentioned, for example, lending or SME banking or trading. And many neobanks have been already had a successful start in those three pillars. So the moment when they're actually able to master one or two of these three pillars, you should definitely expect that these neobanks become profitable. So if I was a traditional bank, I wouldn't wait until new banks are struggling with profitability, because that might flip pretty quickly.
That's an interesting thought, because they have to catch up to the large customer base of the established banks and actually take business from them, because banking as an industry is actually consolidating and not really expanding all that much. How do you think that changed in them and obviously with the current interest rate situation and inflation going around for God knows how long? What do you think is the kind of the trajectory that that fintech should take to be successful in this, also considering the VC funding situation?
So what's very interesting to see is that most modern large neobanks have been founded in the past, let's say, 8 to 5 years. And that means they were all founded during a time of very low interest rates. What does this mean? Well, first of all, capital was cheap, but at the same time, deposits were actually not relevant, or in fact even considered to be toxic, because if you had to pay a negative interest rates to the ECB to keep it there overnight, you actually didn't want to attract very large deposits. And that completely changed now over the past 12 months or maybe 18 months. And those new banks that will succeed on the long term are those ones that are able to change their business model or adapt and expand their business model quickly enough. I'll give you some examples. The new banks that in the early days positioned themselves as an expense account or maybe a salary checking account, they didn't position themselves as a savings account. So that automatically meant the deposits were much lower. Yeah. Vice versa, ING, that started 23 or 22 years ago in Germany as a first country where they started as a digital-only bank with ING DiBa, they initially positioned themselves as a savings account. They didn't start their checking account until a decade or more later. So they position themselves as a savings account. And that's the entire reason why they have a very large deposits and assets under management, but very few checking accounts in comparison.
Right.
And banks such as N26 and Revolut are exactly the opposite. So it's mostly about positioning. Both sides tried to change their positioning over time. ING did that around 2016, 2017 when they launched their checking account in many of their nations and the markets. Vice versa, N26 and Revolut are now more and more going and moving in towards the attracting deposits. And after you attract deposits, it's a very logical step to go and double down on lending as well, which, by the way, most new banks already do as well. So it's very interesting development, what you see. But generally speaking, being able to adapt to changing environments and seize opportunities is one of the key aspects in building a successful bank on the long run.
Right. And especially going to lending, then we're talking automation in the loan decisioning process, ability to compete on cost, on speed, on convenience, on able to select good customers and have like more agile practices in serving customers, which, because at the end of the day, the lending product is a commodity
Absolutely.
Unless you start getting the bad experience with, longer wait times, documents, and all that kind of stuff from a customer perspective. Let's shift gears into since we're talking N26 European companies. Right now Europe is positioning itself to be a leader in AI regulation, right? So there's aspects of that that are very good and positive. There's aspects where you will where you can ask, well, have they really thought about second, third, fourth order consequences? What's your view on this, and how on the one hand the recent digital legislation piece is not only the AI Act but EU, and also how European companies and European startups as in the context of the fintech space should position themselves for being successful in the global arena, still looking outwards out of the European market and to grow into global companies.
Yeah. So generally speaking, first of all, regarding regulation, regulation is important, and regulation can be both an accelerator and a barrier to growth for fintechs. First of all, however, regulation across Europe enabled Europe to be one financial market from a banking license perspective. And this was a huge growth driver for a lot of the neobanks. Because it enabled, with one bank license from one European market, you can be present in every single EU and even EEA country. And this is a big advantage. In fact, this makes Europe a much more consolidated banking market than the US, because the US, you actually need a banking charter or a bank license in every single state. And so that makes the US a much more fragmented market from a retail banking perspective than Europe. Having said that, however, there are certain aspects that are very fragmented. Anti-money laundering laws are one of them. There are certain EU regulation that define how regulations or how laws should be implemented. But at the same time, countries, and especially regulators in different countries, have very different interpretations on the different regulations of the EU. And this creates a little bit of challenge. This creates a few challenges. And a great example is KYC. KYC, despite the fact that the security standards should be identical across Europe, every country has their own opinion on how its KYC should be done for retail banks and businesses. And this, from my perspective, is a weakness. And from my perspective, also creates loopholes, which potentially criminal actors would be able to exploit.
Your experience with Hawk AI ties directly to that, right? With leading a startup and growing a startup that deals with just creating a digital solution that automates and improves anti-money laundering capabilities and KYC capabilities of banks. But if you think of the larger context of digital infrastructure and the ability of, let's say, new players to come into the market, new fintechs to tackle other areas of the digitization, do you think that European startups are well positioned to do so compared to others? Like, should you found a fintech in Europe, should do it in US, should do it in Asia? What do you think?
Yeah.
I mean, obviously advantages, disadvantages, but what's your take on that?
Yeah. So generally speaking, in fintech, that's actually one of the areas where Europe is very well positioned. So many very large fintechs are either based in the EU or the UK. So generally speaking, this is a great starting point. Second, in fintech, it's not just about market location, but actually also about licensing. So there are different types of fintechs, of course. There are certain fintechs that need a license and certain that don't, for example, infrastructure companies. Regarding licensed entities, this is where Europe certainly shines, because it provides access to a very large market. And in fact, it might be actually one of the largest single markets where you can operate with one bank license. On the other side, however, with fintechs that do not need a licensed entity, for example, if you have banking infrastructure or compliance or fraud detection, all that, it is actually kind of irrelevant where you're located. The one exception, however, is how you deal with data protection. So
Right.
generally speaking, the EU has the strictest level on data protection. And what we're seeing is, as a European player, is actually a lot easier to convince international players to be appreciative of the standards that the EU sets, rather than American players that may just not be used to that. Having said that, that's a very specific situation for fintechs where data protection is actually appreciated and wanted also from all regional regulators. This is very different, for example, when we're speaking of pure AI companies where data protection could be seen as a barrier to growth.
It's actually a very interesting point, meaning that, yeah, I mean, it is it's one of those things that actually worked out great, and can be used as an advantage of Europe to kind of, because there's the regulatory export the US is doing in a lot of areas, and also in the financial industry, but also Europe has a say in the world, and I think this exporting our data protection ways is a great opportunity and also the right thing to do. Yeah, I mean, what do you think in general? I mean, you obviously working with Hawk AI. This is one of those companies that automates the process of KYC and AML, which employs a lot of people with banks. One of those classical digitization cases where, let me put it this way: is this AI going to eat out jobs in the banking, or is it an opportunity to create different jobs? What's your view on this impact on, let's say, on the financial industry as a sector? Driven by the recent advancements in AI and Gen AI.
Yeah. So let's maybe take this example of Hawk AI. Hawk AI is a company, a Munich-based company that is helping banks, payment firms, and fintechs around the world to fight financial crime, such as money laundering. And in this specific case, it's actually not about whether AI is killing jobs, but in contrast, banks, in order to comply with local regulations and fight financial crime, they would have to hire so many more additional anti-money laundering experts, and so invest so much more additionally just in order to just keep up with regulations that is basically impossible to find as many people. So a company such as Hawk AI, by automating many processes, by being more accurate in detecting risky transactions and accounts, and in fact also being able to drastically reduce the false alert rates of money laundering, enables them to shift investments from just hiring more and more people, which is basically impossible to do at scale, towards automating certain processes. So a company such as Hawk AI is not by definition substituting anti-money laundering jobs, but rather becoming a virtual companion to these teams and essentially a first line of defense that is truly helping and enabling these compliance teams to focus on those cases that really matter, rather than sorting out thousands and thousands of false alerts.
False alerts, yeah. So it's a good example. There's just so much more that generative AI can do in the banking space. What do you think are the interesting immediate use cases that maybe obvious, maybe not so obvious, that that relevant, let's say, for banking and insurance, like the financial industry in general? Mm-hmm. I mean, obviously, this is a hot topic. Everyone's talking about it, but what's your take on this Gen AI craze?
So generally speaking, there are three very obvious use cases for banks, and then there are a few less obvious ones. So the most obvious ones are, first of all, detection of fraud or money laundering. So basically really being used in the compliance space. Second, being able to enhance or even accelerate and improve customer service. And generally speaking, in future, customers might actually appreciate speaking to an all-knowing algorithm that is available 24/7 in any language the customer pleases, rather than being tied to the opening hours of customer service and then waiting in the hotline, a waiting list for half an hour. And third, personalization of banking. The truth is, one of the biggest challenges for established banks is that they try to serve essentially everyone in a country with one single product. And you can imagine how difficult, or frankly speaking, impossible it is to build one app that equally well serves an 18-year-old boy that is spending most of his awake time on TikTok, at the same time also serve an 80-year-old grandmother based in the countryside.
Right.
It's impossible. However, generative AI could personalize the entire user experience in a way that has never been seen before. And we will definitely see that in the upcoming years.
Yeah, it'll be a very interesting thing to follow, because the non-obvious way would be how their experience, and also with handling all these back office activities and documents and all that, would change. So I think at the end of the day, the customers will experience less stress with banks dealing with mortgages and approvals of various kinds, and having, like you said, more tailored also products that otherwise are just you're just basically left at whether you get a random good person at the branch who cares about your case and can give you the right product, or more generic retail one size fits all approach. Mm-hmm. So yeah. It is it's interesting to see also whether by doing that we'll see more of these major big AI models being used for various things, or whether you see actually the need for customized, let's say, smaller AI models tailored to solve a particular problem, let's say in the financial industry, or whether it would be like GPT-5 for everything, including for banks. What do you think? I mean, it's a long shot, right? What's your feeling about this?
Yeah. So first of all, obviously, any prediction is going to be wrong to a certain extent. But my personal expectation is that we're going to see more general large language models for consumers, such as ChatGPT, for example, and these models might evolve into full-scale digital assistants in the future that basically can take over any tasks that an end consumer might want. On the corporate side, however, I do expect many very specific tools for different use cases. And the reason is quite simple. The margin for error for corporates is typically a lot lower than for consumers. And it is ideally being used in an automated fashion where no human interacts with these Gen AI models on a daily basis, but rather that where different Gen AI models are speaking to each other. Hence, the specialization is certainly very important, especially in banking where the margin for error is even lower.
It's even lower. Yeah, I mean, it's interesting how this technology, if you take a step back, who's it that made the comparison that, it used to be that, such technology was first, utilized by governments or military programs, then by large corporates, and then by small mid corporates, and then by, the end consumer. But now with these models, it seems like they turned it upside down. And now, like I said, they're driven by consumers interacting directly with 100 billion parameter model, and then smaller companies are figuring already out how to automate their things, and in the large companies we're sitting and thinking, okay, no one should have access to OpenAI because of obvious reasons. So they're kind of slow to catch on, and that's what I'm thinking is another one of those. I mean, your feeling and prediction about is this like what percentage of that added benefit by this new technology, or like this disruptive benefit, would be basically yielded by the fintechs and the smaller startups figuring these solutions, or would it be the large corporates that actually their use cases are more impactful, that will be able to utilize this technology, deploy it at scale, and kind of continue to be incumbent in the financial space?
Yeah. So generally speaking, it shouldn't come as a surprise that these solutions caught on first for people, because initially the way that OpenAI launched their solutions was, first of all, in I would say it basically experimental fashion. At the moment, despite the fact that so many people use ChatGPT and other products such as DALL-E and others, technically speaking, they're all in a beta phase. That means these apps, these solutions are fairly low priced in order to be able to collect lots of data from the way that they are being used. So these models will improve over time because they're being so massively used by end consumers. And only then, after they are becoming better and better, then they're being rolled out to larger corporates. It's one thought. The second aspect is, however, that, as I mentioned before, is I believe that for consumers, it's actually beneficial to have one virtual assistant that can help you in any aspect, rather than flipping between different tools for, let's say, writing an email versus doing something else. So I believe that based on ChatGPT and other OpenAI products, we're going to see a lot of products that are going to be tailored towards corporates. The huge danger for many of those companies, however, that they're very dependent on the large language models of OpenAI. And It's going to be very interesting to see whether OpenAI is going to remain as collaborative with these third-party companies, or whether OpenAI rather prefers to take over part of that market themselves eventually, especially given the large stake of Microsoft in this company.
I've said it before, I think just generally the companies that went and said, okay, let's put a hold on AI research. Well, for me, regardless, not to name names, but it sounds to me like an attempt for regulatory capture, because to keep this disadvantage that they have, and lock other smaller players and open source models from gaining the traction that they'll need to compete, right? Luckily, with the internet, many years ago, we saw that that did not happen. It did not get captured by a single corporate entity and became this global thing. And at least my hope is that we have the alternatives, that we have kind of research. I think the universities are trying to catch up frantically, because they were kind of left out a bit, I feel, from most of the cutting edge stuff happening in the AI space. And so that there are alternatives. I think in the financial industry, probably would see a lot of on-premise deployments, right, of such infrastructure, where they would really not like to bet the farm on even on Microsoft with OpenAI, but rather have the options, right?
I personally would be surprised if on-prem is going to be a major driver for AI, frankly speaking, except for high, I would say, maybe military usage. For banks, I believe it will be rather cloud-based, because just the quality is going to be just so much better.
I'd like you to be right, but to be honest, just to say, one of the things that we're doing is working actually very advanced stage. We have a product that automates our migration work from migrating SAS to Python code, with all the aspects to it. Just a moment of advertising. An interesting thing there is that we said, well, look, prompt engineering, selection, keeping the whole flow professional, with ensuring that the code you migrate. There are projects that were impossible before because of costs that now are possible. However, the question of model choice is an immediate one, right? And if banks saying, okay, we're willing to invest a 7-digit figure right away in setting up infrastructure for hosting it, we're not sure that we don't want to get any data out to Microsoft, even Microsoft in Europe, under regulation, under all the. I also think that's likely to change. I think they will quickly concede that it's neither safer nor better nor in any way more, profitable to bet that and do this on-premise major installation of these models, rather than just cooperate with one of the big clouds and make sure that you have a European type contract and kind of procure that capability from within Europe in order to move on with your digitization, right?
So I think generally we're certainly going to see a lot of very large established banks running a dual tier strategy for quite a while, meaning they're still going to maintain and sustain their existing on-prem solutions, in addition expanding and adding cloud-based solutions. At the end of the day, a lot of the innovation that is nowadays happening is focused on the cloud. Sometimes they're offering private cloud solutions, sometimes even on-prem solutions. But the reality is cloud-based solutions are nowadays so advanced and so, you could say, so much more sophisticated than on-prem solutions, and that if you would limit yourselves completely to on-prem solutions, it may actually hamper the overall innovation in a bank. But
absolutely,
I would certainly expect a dual tier strategy, the dual tier strategy continue to many for many banks.
But I think we're seeing. I mean, it's almost funny because we've been talking about this for years, but now it seems like the CIOs and general management teams of IT management teams in the banks, they have the tables have turned, and they need to bring the reasons to the CEO why not to go to the cloud rather than the other way around. Previously,
That's a good observation. I think what we're seeing in the past 6-7 years, we went from basically CEOs of banks saying cloud is completely unsafe and shouldn't be used for banking, towards when can we let's explore and let's start a pilot, to actually now needing to justify why cloud isn't being used for certain aspects. So it completely flipped in terms of the last 6-7 years. And I would expect a lot of the future technology investments of banks going to be funneled towards the cloud infrastructure.
This is also something that the European regulators, I think, are still struggling with. Although there's been significant progress in defining what cloud is in every individual country in Europe, right? Because they have a different interpretation, different local requirements. So cloud is not the same in Germany as it is in Poland, for example, and is slightly different than it is in Austria, right? In terms of what you can and cannot do. But I think we'll see also in terms of regulation more consolidated approach, and some of these things are becoming industry standard, and there's no need for individual adventurers trying to explain to everyone why this is a great idea versus just because it's new, and it's still safe and sound, and actually the best way to go for the bank and for the customers. It essentially means that the further, if this continues to be the case, then the three large clouds are going to become even more relevant for Europe, right? For the banking industry, because it still largely sits in own data centers and basements and all sorts of own buildings where clearly then the own team doesn't have the capability, the knowledge to even do the security nearly as close as a Microsoft or Amazon or Google can do it. So that ultimately should be actually a better step forward for the European banks. Let's change gears again. I'm interested in you have a very, very interesting and successful career so far. From a leadership perspective, what do you think is the one, or let's say a few critical aspects for, just to give you let's say an audience is a new team lead or management department head. What are the first things that they should focus on to turn around kind of the area that they're responsible for within? That could be in IT, in back office IT, in software development IT, in risk IT, finance IT. What are critical elements to look for immediately to get that digitization successful on the way?
Yeah. You mean for newly appointed leaders?
Let's say for newly, just to consider people that are just brand new in this role of department head or team lead, what should they focus on?
Yeah. So generally speaking, I would recommend to do two things. First of all, success in a transformation starts and ends with the team. So building a world-class team that suits your purposes and really brings in complementary and very diverse opinions and skill sets is key. So understanding what needs do you have, what skill sets and people do you currently have, and how should you build the team going forward is absolutely fundamental. The second aspect is to understand where the opportunity is, how does it fit into your current structure, and what's the best way to get there. It's not always that building and transforming the existing business is the best way to do it, because sometimes it's better to start on a blank page and think how would you build a modern tech stack today, rather than what's the best way to improve your existing tech stack by 5 to 10%.
Right.
In fact, there have been very successful transformations where you essentially just build something completely from scratch and then slowly migrate new business onto the new tech stack while still maintaining the old one for a while. This can be a very successful strategy. However, it's very important to first understand what do you want to build, what's the target operating model, before you look at your existing infrastructure to think how you can improve it marginally, because that's not going to get you far.
Absolutely. I think we need more bolder leaders that think like that, and don't see themselves only custodian of a certain tech stack and keeping it operating, but they're really willing to go out and propose changes in the target operating model. Sometimes it's painful for teams are changing, things are changing, technology stacks are changing, but that's a good that's very good advice. In your personal opinion, I mean, you've had the roles of both, kind of building as an entrepreneur, as a manager, and as an advisor. Which are the roles that you think are better, where you had a better experience, or that you prefer better personally? How are they different for you?
You mean between manager, leader, advisor, entrepreneur?
Seeing it from three perspectives, right? Mm-hmm. Be either advising someone to do something and they can do it, or not do it, take the advice, or being kind of like the entrepreneur, where you're really risking something to build something with a vision, versus being a manager of already established, working momentum. I think they're three distinctly different roles.
Yeah, that's true. I mean, first of all, I was in a very lucky position that, in fact, I could look and work with banks from four very different perspectives. I've advised banks back during my time when I was at BCG. I built and managed a bank at N26. I provided banking infrastructure with Hawkeye and other providers. And on the last page, especially when I worked at Hawkeye, we worked very closely also with regulators, not being supervised, but actually supporting regulators to innovate by themselves. And this is a very distinct perspective that I was very lucky to have, which actually helps me now to better understand how regulators look at new banks or banks in general when they supervise them. Generally speaking, you're absolutely right. Very different perspectives. I'm very lucky to have had all of them. Generally speaking, I see myself as an entrepreneur and change maker. Whereas right now I'm advising businesses. Still, I think like an entrepreneur. I think like an owner and a shareholder of the businesses I'm working for. And that hasn't changed as a manager either. Even as a manager, I thought like an owner, a co-owner of any of the companies I was working for. And the same I'm doing with many of the companies I'm working with. And frankly speaking, I'm currently in a great position that I can work with very new and very innovative businesses, very often where I'm even investing or part of the advisory board, where I've now accepted 2 mandates. On the other side, I'm also working for very large, very established banks or payment firms that want to transform themselves into a more digital business. And even in that case, I want to look at it from an ownership perspective. How would I take decisions if I was a shareholder of that company? And how can I enable the CEO and the board overall manage their digital transformation in a better and more accelerated way?
So I'm getting that you basically enjoyed all 3 roles personally in the same way. They're just different things. It'll be quite a challenge, even from an advisory perspective, right? Because a lot of the infrastructure is old, and banks will realize that at some point they have to. That's my Amazon delivery, by the way. So we're gonna have to record that again. So a question is also a kind of a leadership question, but from the other side, is evaluating investments in basic infrastructure, in migrations, in, I guess, from things such as core banking to master data management and underlying infrastructure that doesn't have an immediate obvious business case, and it will run in parallel for quite a while until you can shut the old system down. In your advisory role or leadership role, what do you think are critical questions to ask, and how should banking leaders view this sort of problem when deliberating on major investments in modernizing the infrastructure?
Yes. So there are two recommendations to that. So first of all, infrastructure investments should be seen as what they are. They're investments into the future, and they're essential. The longer you postpone them, the more expensive they can get. And in fact, you may take, if you don't do them, you have to invest into other aspects on top of the old infrastructure that might become obsolete on the midterm. Yeah. So as an advisory board or a supervisory board of a bank, I would expect these board members to insist on making provisions for infrastructure investments, and in fact, to also expect that on a regular basis, even if it may harm the result on the midterm. It might reduce the result on the midterm, but the CEO should in that case not just be measured by the financial impact, but also whether they are keeping to the plan in infrastructure investments and also according to certain milestones. Because the most challenging aspect of an infrastructure investment is actually if they are too long postponed and then go wrong, like a core banking migration that goes horribly wrong. And that's where the board needs to put an eye on it to ensure the quality of these infrastructure investments is being upheld and not that they are being postponed. So postponing infrastructure investment should not be incentivized by the supervisory board or board of advisors.
That's a great insight. I think it's a great insight, and from even if your supervisory board doesn't insist on that, if you were to do as if they did, then it'd still be more optimal than just not doing it. Great perspective on the leadership. Maybe one personal questions. What books do you read currently? I mean, you're obviously traveling a lot, doing a lot of things. Do you have time to read? And if so, which books is Georg Hauer looking at?
Yeah, so I love reading, and I read very different types of books, partially business, partially a lot about different cultures and countries. I'm actually, as a matter of fact, really a geek on when it comes to history and geopolitics. I love reading books, especially about countries and regions that are not very present in the newspaper. So definitely can recommend there are a few books. If you want a specific recommendation, I can highly recommend The Psychology of Money. I just finished a book recently. Great book to have a better understanding of how people think about money, frankly speaking, even for your own personal finances. And other than that, in terms of current geopolitics, I definitely recommend anyone to pick up a book on either the history of the Middle East. Peter Mansfield wrote a great book on that. And another book I would highly recommend because I enjoy traveling in Africa, The State of Africa. There's a great book on that. Frankly speaking, I think a lot of people don't really realize neither the history nor the long-term potential of the African continent.
Oh, those are amazing insights. Actually, look into this, especially the Africa book is, I think, particularly interesting because there's a lot of opportunity there. And on geopolitical stage, you have the big guys fighting over who rules Africa, but in the end of the day, I think the Africans themselves will lift them up and themselves up, and technology would be a major driver for this. So, yeah. But yeah, I'll also be interested in reading more on the history. I'm also a history buff. My particular history kind of interest is kind of the Cold War era. So I'm kind of like a Cold War history, and also as a pilot, aviation history is also something that I've read a lot of books on. Very far away from banking and from what we're doing, we have to have hobbies. Yeah. So yeah,
absolutely. By the way, I think first of all, it's important to have hobbies besides fintech. Otherwise, one would be too one-sided. And on the other side, regarding Africa, I do see it also from a fintech perspective, because I do believe the next 10 years is going to completely transform the banking infrastructure and banking landscape on the African continent. And you may see some of the most incredible fintechs emerging out of there. So it's definitely going to be an exciting time.
I would certainly hope so. And yeah, thanks so much for the tips. And yeah, Georg, thanks a lot for that discussion. It was highly interesting to get your opinion on where banking and neobanking and this AI stuff is going. Thanks for being my guest. And yeah, I'll see you and talk to you soon. Cheers.
Thanks a lot. It was a great pleasure being here.